Hello and welcome to Listen Business English. This is the podcast where we explore the language of business, of finance, economics, leadership and global markets, while helping you improve your professional English. I'm Gary. I'm a British English teacher and I've lived in Colombia since 2010. So for the past 16 years, I've helped professionals, executives, entrepreneurs and major companies across Colombia, South America, and around the world to develop the English skills they need to succeed internationally. Today we are discussing one of the most important business stories of our generation, artificial intelligence, AI. Billions of dollars are being invested. Some of the world's most valuable private technology companies are preparing for potential stock market listings. Governments are competing for technological leadership, and businesses are redesigning their operations around AI. But there is one crucial question. Are we witnessing the early stages of the fourth industrial revolution? Or are investors pouring money into the largest speculative bubble since the dot-com era? Let's begin. Now, whether you're a CEO, a manager, an investor, an entrepreneur, or an employee, AI is becoming impossible to ignore. Boardrooms around the world are discussing AI strategies. A boardroom is the meeting room where senior executives and directors make business decisions. Companies are increasingly asking questions such as, how can AI improve productivity? How can AI reduce operating costs? How can AI create competitive advantages? And how can AI generate new revenue streams? A revenue stream is a source of income generated by a business. For example, you could hear subscription services have become an important revenue stream for many software companies. Now, the business world has largely moved beyond asking whether AI matters. The discussion is now focused on how quickly companies can adopt it without falling behind competitors. To fall behind just means to become less advanced than others. So let's start with the numbers. The scale of investment flowing into AI is extraordinary. Technology giants like Microsoft, Google, Meta, and Amazon, they are spending hundreds of billions of dollars building AI infrastructure. Meanwhile, the AI-focused companies like OpenAI and Anthropic, they continue to raise enormous amounts of private capital. When we talk about capital raising capital, this just refers to obtaining funds from investors to finance growth. Businesses typically raise capital for three main reasons: expansion, research and development, or infrastructure investment. AI companies need all three. Unlike, say, traditional software businesses, AI requires massive physical infrastructure. In this case, data centers, semiconductor chips, energy supplies, and cloud computing networks. This is why many analysts believe AI is creating not only a software revolution, but also an infrastructure boom. So I'll give you a little bit of a business vocabulary focus. Capital expenditure, CapEx. This is one of the most important business terms in this discussion. So CapEx, capital expenditure, refers to money spent on long-term assets that will generate future value. Examples could be factories, data centers, machinery, technology infrastructure. So when Microsoft builds a billion-dollar AI data center, that is CapEx spending. Many analysts describe today's AI race as one of the largest CapEx cycles in business history. You'll hear the potential IPO wave. One reason investors are paying close attention to AI is the possibility that major private companies may eventually go public. An IPO, an initial public offering IPO, this occurs when a private company sells shares to the public for the first time. So why would an AI company pursue an IPO? Well, it's principally because AI development is so expensive. And public markets, they provide access to enormous pools of capital. However, IPOs also create challenges. Public companies, they face greater scrutiny, examination, reporting requirements, shareholder pressure, and regulatory oversight. So scrutiny means close examination. And public investors, they expect transparency. Now, transparency can be uncomfortable for companies whose business models remain uncertain. And that brings us to one of the most important business questions here. How exactly will AI companies make money? Or to use a key business term, how will they achieve monetization? Monetization is the process of converting a product or a service or technology into revenue, into income, business income, revenue. Many AI companies, they've attracted enormous valuations. But valuation and profitability are not the same thing. A company can be worth billions of dollars while generating little profit, if any. And that's why investors are increasingly asking, where are the profits? Where are the sustainable revenue models? Where is the return on investment, the ROI? Return on investment, ROI. ROI measures how much profit is generated compared to the amount invested. There's a formula here, ROI equals profit divided by investment. Every business decision ultimately comes back to ROI. Companies investing in AI today must eventually demonstrate measurable, verifiable returns. If they cannot, investors will lose confidence. Now, many business analysts compare today's AI boom with the dot-com era of the late 1990s. At that time, investors became convinced that the internet would transform business. And they were correct. But they overestimated one thing, just how quickly profits would arrive. And this created what we call a speculative bubble. A speculative bubble, this occurs when prices rise mainly, because investors expect future gains rather than because of the current fundamentals. When I say fundamentals, I mean the underlying financial performance of a company. Examples of fundamentals can include revenue, profitability, cash flow, and market share. Now, when these fundamentals fail to support valuations, markets can correct sharply, quickly, dramatically. A market correction happens when asset prices decline after becoming overvalued. Corrections can be healthy. However, severe corrections can become market crashes. Many investors fear AI could eventually face a correction if these expectations become unrealistic. Companies are racing to adopt AI because they fear missing out on competitive advantages. A competitive advantage is something that allows a company to outperform rivals. Examples could be lower costs, better technology, stronger branding, superior customer service, and many executives believe AI can create all four of these. Another important concept is first mover advantage. This occurs when a company gains benefits by entering a market before competitors. First mover advantage. Examples include Amazon in e-commerce, and Netflix in streaming, and Uber in ride-sharing. Many organizations worry that waiting too long to adopt AI could result in losing first-mover advantages. But perhaps the biggest business question is whether AI is actually improving productivity. Productivity gains are the foundation of most investment cases. If employees can complete tasks faster, businesses save money. If businesses save money, profit margins improve. A profit margin just refers to the percentage of revenue that remains as profit after expenses. A profit margin refers to the percentage of revenue that remains as profit after expenses. Supporters of AI argue that customer service is becoming more efficient, software development is accelerating, data analysis is improving, and administrative tasks are being automated. Critics, they argue that many organizations are still struggling to produce measurable results. In business terms, we would say that AI has not yet proven its value proposition. A value proposition, that's just the benefit that a company promises to deliver. The next 12 to 24 months may determine whether AI delivers on its promises. Now, one thing business history teaches us is that technological revolutions create winners and losers. The winners are not always obvious. During the internet revolution, many famous companies disappeared, new companies emerged, and entire industries were disrupted. To disrupt means to fundamentally change how an industry operates. And AI is already disrupting marketing, customer support, software development, education, legal services, and finance. The challenge for businesses is deciding whether to lead disruption or to react to it. Those are very different positions. And investors are also paying attention to what we call corporate governance. Corporate governance refers to how a company is managed and controlled. Strong governance helps protect shareholders. Weak governance can increase risk. And many of these AI companies are closely associated with what we call visionary founders. Investors are often betting on these individuals rather than traditional business models. This creates both opportunities and risks. Visionary leaders can create enormous value, but they can also make expensive mistakes. And business history provides examples of both outcomes. For executives and investors, several indicators deserve close attention. One may be revenue growth. Are AI companies generating sustainable revenue? 2, profitability. Can they eventually produce profits? Then there's customer adoption. Are businesses actually using AI products? Productivity improvements? Are measurable efficiency gains appearing? And what about regulatory developments? Will governments introduce restrictions? And then we have competitive positioning. Which companies are building defensible advantages? These metrics, these measurements, will determine which organizations emerge as long-term winners. So the final analysis, is this a revolution or a bubble? Where does this leave us? I suppose the most realistic answer may be that AI is both a revolution and a speculative investment story. The underlying technology appears genuinely transformative. The business opportunities are enormous. The potential applications, they are almost limitless. However, markets frequently become overly enthusiastic. Investors often price in future success long before it actually arrives. And the key business question is not whether AI will change the world. The key question is this: which companies will successfully monetize AI, generate sustainable profits, and create long-term shareholder value? History tells us that many current leaders will disappear. Others will likely dominate the next generation of business. And some of the biggest winners may not even exist yet. That's what makes this topic so fascinating. We are not simply watching the emergence of a new technology. We are watching the possible birth of entirely new industries, new business models, and market leaders. And that's why executives, investors, entrepreneurs, and employees everywhere should be paying attention. So some of the key business vocabulary from today's episode: an IPO, initial public offering, capital raising, capital expenditure, CapEx. We talked about revenue streams, monetization, return on investment, ROI, valuations, profitability. We mentioned market corrections and competitive advantages, as well as first mover advantages. We mentioned profit margins, value propositions, corporate governance, and we talked about shareholder value and market disruption. So thank you for listening to Listen Business English. If you found this episode useful, follow the podcast, share it with colleagues, managers, entrepreneurs, and professionals who want to improve their business English while staying informed about the forces shaping the global economy. And remember to check out our sister podcasts. I'll leave links to these below in the description. We have Listen Global English for geopolitics, world affairs, and major international stories. And we have Listen Online English, where we concentrate more on grammar and vocabulary, phrasal verbs, idioms, and practical English development. So until next time, keep learning, keep growing, thank you for listening, and keep doing business in English. Bye-bye for now.